You just walked away from a guaranteed $2.4 million year-end bonus. The resignation letter sits on the mahogany desk of your global head of trading. Everyone on your floor thinks you have lost your mind. You have a contrarian thesis on European distressed tech debt, $850,000 in liquid cash, and exactly 120 days before your non-compete expires and the market window slams shut permanently. Most emerging funds do not survive their first 36 months. You do not know yet which side of that statistic you will land on. The fund does not exist yet. There is no glass office overlooking Park Avenue, no institutional investors, no risk management software, just a stack of legal documents that cost $82,000 to draft, and a strategy you have been backtesting on a private server for 3 years, but have never executed under your own legal name. You gave up the infrastructure, the proprietary data feeds, and the one thing that made sovereign wealth funds answer your calls, the trillion-dollar firm's name behind you. None of that institutional weight travels with you. Everything starts from zero. Stage 1, the quit. 0 AUM, you are 38 years old. The separation agreement is fully executed. Your former employer, a 40-person global macro desk managing $8 billion, has already restricted your building access and wiped your phone. Your title there was Managing Director of Special Situations. Your total compensation last year was $2.4 million. You left because you are tired of generating 30% returns on complex credit dislocations, only to watch the firm blend your alpha into their mediocre aggregate performance. That is the justification you tell your spouse. The real justification is that you have been tracking a massive wave of legacy software companies in Europe attempting to refinance their debt. And the spread between their actual default risk and the market's pricing is the widest you have seen in a decade. If you do not launch now, you will spend the next 5 years watching a rival firm print the returns you mapped out. The legal friction begins immediately. You hire 2 law firms, one to structure the master feeder entities, one to negotiate the intellectual property clauses of your exit. The fund documents, the private placement memorandum, the limited partnership agreement, and the ISDA master agreements cost $82,000 to finalize. You sign the engagement letter from your dining room table at 6 in the morning. The lead structuring attorney charges $850 an hour. You wire the retainer without a second thought. That is the first psychological shift you notice. Not the dollar amount itself, but the complete absence of hesitation when spending your own net worth to build the architecture. You establish the management company as a Delaware limited liability company. The fund itself is a Cayman Islands exempted company to accommodate offshore capital. The Cayman setup costs $28,000 and requires 14 business days of relentless anti-money laundering background checks. At your current $0 scale, you do not need Cayman tax efficiency. You need the optics. Institutional allocators demand familiar offshore jurisdictions. A cheaper setup in a lesser-known domicile signals that you lack capital, and you cannot afford to let anyone know how fragile the operation is right now. You file as an exempt reporting advisor with the Securities and Exchange Commission. Full registration is not required until you cross $150 million in assets under management. That threshold feels like a hallucination from where you are sitting. Your personal capital commitment to the fund is $740,000. It represents the remaining balance of your liquid net worth after covering the setup costs. The fund currently manages exactly $740,000. You are the general partner, the limited partner, the head of trading, the chief risk officer, and the IT support desk. You answer every email within 2 minutes because you are staring at a silent inbox waiting for the market to acknowledge your existence. The pitch deck is 19 slides long. The core thesis takes up 5 slides. The historical track record takes 3. The team slide features exactly one name: yours. The first investor meeting is a Tuesday morning breakfast with a Chicago real estate magnate who previously allocated to your old desk. He has $3 million in liquid capital ready to deploy. You spend 4 hours Monday night rehearsing the deck until your throat is raw. He listens for 20 minutes, asks 2 questions about liquidity, and says he needs to consult his tax advisor. He does not return your follow-up call for 14 days. Those 14 days are the most agonizing 2 weeks of your professional life. Stage 2. 935 million AUM, the seed. The Chicago magnate passed. A former client from your investment banking days wired $2 million. A multifamily office based in London committed $5 million after a brutal 3-hour interrogation where a 55-year-old chief investment officer demanded you explain your hedging strategy against currency fluctuations 4 different times. You scraped together another $1.61 million from your personal network. A former college roommate, a retired orthopedic surgeon, and a neighbor who saw you working in your garage and asked for the subscription documents. Combined with your initial $740,000, the fund launches with $9.35 million in assets under management. You do not tell any of them that $935 million is effectively a rounding error in this industry. Management fees at $9.35 million generate $187,000 annually at a standard 2% rate. Your annual operating costs are a completely different reality. The fund administrator, the annual audit by a recognized accounting firm, the compliance archiving software, a single Bloomberg terminal, and a windowless subleased office space cost you $240,000 a year. The management fee does not even cover the lights. The cash bleed is measured in tens of thousands of dollars every month, and it is coming directly out of your remaining personal savings. You are paying for the privilege of working 80-hour weeks. Your prime brokerage relationship is with a Tier 3 introducing broker. You cannot get Goldman Sachs, Morgan Stanley, or JP Morgan on the phone. Every top-tier prime broker has an unwritten minimum threshold of $50 million in assets before they will even assign a junior coverage officer to your account. Because you are below that line, you route your trades through the introducing broker, suffering wider spreads, higher financing costs, and a user interface that looks like it was built in the late 90s. You absorb the friction silently. You reconcile every trade manually on a spreadsheet because the automated portfolio management system you need costs $80,000 a year, which is half your entire fee revenue. The fund is up 14.2% in the first 7 months. The returns are pristine and the high watermark remains unblemished. You know this performance is exceptional, and you also know it means absolutely nothing to the institutional world. Track record in the hedge fund industry requires a 36-month minimum. Anything under 2 years is considered statistical noise. The performance is real, but to the capital allocators who matter, you are a ghost. The first redemption notice hits your inbox in month 8. $750,000. It is the college roommate. He is going through a hostile divorce, and his assets are being liquidated by court order. It has nothing to do with your performance. It is just the collateral damage of human life intersecting with locked-up capital. You process the redemption wire without a single word of complaint. Factoring in your earlier gains, the fund drops to $9.9 million. Your fee revenue shrinks again. It takes 3 months of relentless networking to replace that capital. Then a boutique placement agent sends a cold message on LinkedIn. He saw your 9-month performance numbers in an obscure alternative data registry. His firm advises 4 European family offices with a combined $400 million in hedge fund allocations. You spend 45 minutes drafting a 4-sentence reply. You read it aloud 7 times before hitting send. Stage 3. 65 million AUM. The legitimacy test. The placement agent introduced you to 3 of his clients. 2 of them passed because your assets under management were too low for their internal risk limits. The third was a Swiss fund of funds that allocated $25 million after a grueling 4-month operational due diligence process. A separate introduction from a capital introduction event in Miami yielded $15 million from an insurance executive who understood the exact mechanics of the European tech debt you were shorting. The placement agent took 20% of your management fee on the capital he brought in for the first 3 years. You signed the fee-sharing agreement without resentment. That is the tax you pay for survival in the early days. The fund sits at $65 million. Management fees are now $1.3 million annually. For the first time since you walked out of your old firm, the business generates more cash than it incinerates. The operational complexity has scaled aggressively. You hired a quantitative modeler poached from a proprietary trading firm at a $180,000 base salary. You upgraded to a Tier 1 fund administration platform. You brought on a dedicated chief operating officer to handle the crushing weight of compliance filings and vendor management. Total operating expenses hover around $850,000. The margin is finally positive. Your personal draw from the management company is $350,000 this year. After taxes, it is the first time in 24 months you are not watching your personal checking account slowly drain to zero. You notice the absence of that specific financial anxiety the way you notice when a persistent ringing in your ears finally stops. The fund closes year 2 up 18.5% gross before performance fees. The performance fee math changes your life. 18.5% on $65 million in assets is a gross gain of $12 million. Your 20% performance allocation on that gain is $2.4 million. After paying the quant analyst his guaranteed bonus and covering the remaining overhead, you retain the vast majority of it. It is the exact moment the operation transitions from an expensive, highly stressful personal trading account into a legitimate financial enterprise. An investment consultant from a major advisory firm reaches out. His group builds the alternative investment portfolios for mid-sized university endowments. They are constructing an emerging manager sleeve and want a full operational due diligence package submitted within 14 days. You and your COO spend 80 hours over a single weekend, compiling 56 separate documents. The trade allocation policy, the cybersecurity penetration test results, and the audited financials. You transmit the encrypted file room link 12 hours before the deadline. The real game has officially started. Stage 4. 180 million AUM, the business. The endowment due diligence process consumes 9 months of your life. They send forensic accountants to review your expense ratios. They interview your prime broker. They analyze your trade slippage during volatile market hours. At the end of the gauntlet, a private university endowment with $3.1 billion in total assets wires $40 million into the fund. The terms are brutal, demanding a 2-year hard lockup, a 120-day redemption notice period, and a customized transparency report that requires your COO to map every single position's risk exposure on a weekly basis. Every single term is non-negotiable, yet you accept them instantly. Turning away institutional capital at this inflection point is a fatal error, and you are acutely aware of it. 4 additional allocations follow in rapid succession, pushing your assets under management to $184 million. You cross the regulatory threshold. The SEC registration becomes mandatory. You are now a formally registered investment advisor. Your Form ADV is published on the public internet. Any journalist, competitor, or prospective allocator can look up your exact regulatory assets, your gross exposure, your fee structure, and your disciplinary history. That disciplinary section must remain blank for the entire lifespan of your firm. The team expands to 7 people. You, the COO, 2 quantitative analysts, a senior trader executing your orders, and a dedicated compliance director making $220,000 a year to ensure you never violate an SEC mandate. The 2% management fee on $184 million covers the entire payroll with millions in surplus. You stop checking the daily fluctuations of your personal portfolio. It takes 6 months to fully break the habit of scarcity. Then the catastrophic quarter arrives. Year 3, quarter 2, down 11.2%. The macroeconomic thesis was fundamentally correct. The underlying European tech companies were defaulting exactly as you modeled. But a massive German payment processing firm collapsed in a localized fraud scandal, triggering a sector-wide margin contagion. The illiquidity in the debt markets caused your introducing broker to panic. They increased the margin requirements on your highest conviction short position from 15% to 45% overnight. You were forced to liquidate a third of the portfolio at a severe discount just to meet the margin call. 3 weeks later, the market stabilized and the position rebounded exactly to your target price. You were completely right about the asset. The quarter's performance said you were completely wrong. These 2 realities exist simultaneously in the market, and being right on the timeline of years does not save you from being liquidated on the timeline of days. 3 investors submit redemption notices. $14 million walking out the door. A fund that had compounded its way to $195 million now sits at $160 million. You draft a letter to every single limited partner. You do not use a sanitized PR template. You write a brutal forensic autopsy of the quarter. You detail the exact mechanics of the margin call, the failure in your liquidity modeling, and the hard-coded risk limits you have implemented to ensure a localized contagion never forces a liquidation again. One of the redeeming investors cancels their notice after reading the letter. 2 of them proceed. The catastrophic quarter teaches you the ultimate lesson of asset management. Your investor's capital operates on a timeline of anxiety that has absolutely nothing to do with your mathematical models. A drawdown that you analyze, internalize, and correct within 48 hours will permanently scar their institutional track record for as long as they allocate to you. The financial loss is yours for a month. The reputational damage is theirs forever. You never allow a margin mismatch to dictate your sizing again. Stage 5. 600 million AUM. The institution. The prime brokerage landscape shifts entirely. Morgan Stanley calls you. At 180 million in assets, you are finally profitable enough for their prime services division. The migration from your mid-tier broker to Morgan Stanley takes 14 months of excruciating legal and operational integration. The difference in execution is staggering. You secure massive reductions in financing rates, bespoke portfolio swap arrangements, and most importantly, access to their capital introduction desk. You are assigned a dedicated team whose sole purpose is flying you around the world to present your fund to the largest sovereign wealth funds and pension boards on Morgan Stanley's client list. You close a $60 million allocation from a Texas hospital system through a capital introduction event in year 4. A $150 million injection from a Japanese life insurance company arrives the following autumn. That single allocation was the result of a due diligence cycle that lasted 22 months and required you to fly to Tokyo 3 times. The fund breaches $615 million in year 5. The fee structure has permanently mutated. Institutional allocators do not pay 2%. They negotiated your management fee down to 1.25% as a strict condition of their 9-figure checks. Tiered fee discounts are the toll you pay to cross the $500 million mark. The economics are still staggering. Management fees at 1.25% generate $7.6 million annually. The performance fee last year was generated on a 16% gross return on your previous $450 million asset base. $450 million multiplied by 16% is a gross gain of $72 million. Your 20% cut of that gain is $14.4 million. After paying out massive retention bonuses to your quantitative team, covering the bloated operational overhead, and settling the revenue share with your early placement agent, your personal take-home is $10.5 million. You went from a $350,000 draw in year 2 to $10.5 million in year 5. The mathematical leverage of owning the management company is absolute. The team is now 16 people. 4 execution traders, a head of investor relations managing the relentless demands of institutional reporting, a full-time chief risk officer, and a dedicated cybersecurity engineer. Every single new hire is heavily vetted. The culture is hermetically sealed. Institutional due diligence is no longer just about your returns. It is an invasive audit of your firm's soul. Allocators send specialized operational teams to spend 3 days in your office. They review your server architecture, your personal trading compliance logs, your disaster recovery backup sites, and they demand a legally binding key person clause. They force you to take out a $50 million life insurance policy on yourself, payable to the fund, and require a granular, step-by-step succession matrix detailing exactly how the portfolio will be liquidated and returned to investors if you are hit by a bus. You did not have a succession plan until a Swedish pension fund demanded one. It took 2 law firms and 6 months to build it. You no longer run a hedge fund. You run a financial institution. Funds survive on the brilliance of their trades. Institutions survive on the redundancy of their architecture. This realization alters every single hiring, software, and real estate decision you make. A 72-page questionnaire arrives from a sovereign wealth fund's emerging manager pocket. They manage $300 billion globally. Their minimum allocation size is $200 million. You cancel a family vacation to Aspen and spend the next 4 days answering all 72 questions with your COO. Stage 6. 1 billion AUM, the number. You are 43 years old. The fund officially crosses $1 billion in regulatory assets under management on a Thursday morning in October. There is no champagne. There is no speech to the trading floor. The portfolio management software simply ticks over from $790 million to $1.01 billion. Your COO sends you a text message with a screenshot of the dashboard. You are in the middle of analyzing a distressed debt covenant in Milan. You finish reading the covenant. You reply to the text with a single check mark. The Sovereign Wealth Fund wired $220 million at 9:15 a.m. That wire, combined with the organic compounding of your existing capital base, pushes you permanently into the billion-dollar club. The entire life cycle from their first cold email to the final capital call took exactly 2 years. The management fee on $1 billion at 1.25% is $12.5 million a year. That fee alone covers every single employee, every data terminal, every legal retainer, and the prime real estate lease, leaving millions in pure profit before you even make a single successful trade. The performance fee last year, based on an 18% gross return on your previous $750 million asset base, generated $135 million in total gains. Your 20% performance allocation is $27 million. After the profit-sharing pool for your partners and the operational tax drag, your personal economics for the year exceed $21 million. You walked away from a $2.4 million bonus. You are now netting $21 million a year. The asymmetry of founder equity is the most powerful force in finance. The firm employs 22 people. You elevated your lead quantitative analyst to Deputy Chief Investment Officer in year 5, right after a severe bout of pneumonia knocked you offline for a week and terrified your institutional base. You decentralized the risk book before an allocator forced you to. That proactive governance is the only reason the Sovereign Wealth Fund did not pull out of the deal. You occasionally look at a framed copy of your original resignation letter. You do not keep it there to stroke your ego. You keep it there because the 38-year-old who signed it was operating blind, risking his entire net worth with an 80% probability of absolute ruin. And you need a daily reminder of what true risk feels like before institutional comfort makes you soft. You built a billion-dollar institution. The $220 million allocation that pushed you over the edge came from a sovereign wealth fund managing the generational wealth of an entire nation. The final allocation vote was held in a secured boardroom in the Middle East. You flew there, presented your thesis to 6 managing directors for 40 minutes, and immediately drove back to the airport. The internal investment memo that actually secured the capital was written by Priya. Priya is a 35-year-old quantitative risk analyst working deep inside the sovereign fund's manager selection team. Her annual salary is $105,000. Her sole directive was to try and break your portfolio. She spent 8 weeks inside your virtual data room. She built a Monte Carlo simulation, subjecting your distressed debt strategy to the exact volatility of the 2008 financial crisis and the 2020 pandemic shock. She mathematically proved that your covariance matrix held up better than 42 competing funds in their pipeline. More importantly, she flagged your catastrophic 11.2% drawdown in year 3. She traced the exact margin call, read your brutally honest letter to the investors, and wrote a 3-page addendum arguing that your immediate implementation of hard-coded liquidity limits proved your operational maturity. That addendum is the singular reason the investment committee authorized the $220 million wire instead of rejecting you for volatility. You have never met Priya. You shook hands with her managing directors. You presented to the board. Priya was not allowed in the room. She was sitting in a cubicle 4 floors down, writing the next risk model for the next fund in the queue. Your billion-dollar empire did not materialize purely because you were a genius at pricing European debt. It materialized because a 35-year-old analyst, making a fraction of your monthly server costs, looked at the absolute worst moment of your career, analyzed the architecture you built to fix it, and decided your failure was defensible enough to stake her own internal reputation on. Priya's risk model is the structural foundation of your current net worth. Her name does not appear on your website, your pitch deck, or your SEC filings. The capital she unlocked is the reason the firm is what it is. Somewhere right now, a managing director at a massive bank is staring at a resignation letter. He has a brilliant macro thesis, he has his life savings, and he thinks he understands exactly how the game is played. He has absolutely no idea how the capital allocation machine actually works. He will spend the next 7 years bleeding cash, surviving margin calls, and building institutional architecture just to earn the right to be scrutinized. And somewhere in a sterile government office, an analyst exactly like Priya is already downloading his data. If you want to understand the hidden mechanics of how institutional capital actually flows and why most funds fail, subscribing to this channel helps me keep producing these breakdowns.